Have you ever opened a company's financial report and felt like you needed a secret decoder ring just to get past the first page? Yeah, you are not alone. Today, we are going to run what we call a clarity audit. We're going to translate that dense corporate speak, break down the walls of text, and uncover the hidden risks that are often hiding in plain sight.
I mean, we've all been there, right? You're staring at a page, a document that's supposed to give you answers, but it just leaves you with more questions. It's frustrating, and it really makes you wonder what is getting lost in translation between them and, well, us.
And this, right here, is the heart of the problem. When language is unclear, it can actually hide a company's true financial health. Sure, they might be ticking all the legal boxes for compliance, but that doesn't mean you or I really understand the full picture or the risks they're carrying. We call this massive barrier the wall of jargon. Seriously, it's a wall. It's built with language designed to satisfy lawyers and regulators, not to actually inform you. And it's what stands between the raw numbers and you genuinely understanding what they mean for the business. So, how do we get through this wall? Well, we use a really simple but incredibly powerful tool that we've developed called the Clarity Audit. Think of it as our way of being a universal translator for these super complex documents. The whole method is basically a side-by-side comparison. It's that simple. On the left, you've got the before, that's the original, super dense language we pulled directly from a report. And on the right, you've got the after, our plain English translation. It keeps the essential truth, but makes it instantly understandable. Okay, enough talk. Let's actually put this audit into action. We are going to dive into 3 really common types of company debt that often get buried in confusing language. Let's see what we can dig up. So, first up on our audit list is something called contingent liabilities. Sounds pretty formal, right? We just call it the maybe debt, because that's what it is. It's a potential financial hit that all depends on some future event. Now, just look at the difference here. On the left, the original jargon talks about provisions for obligations of uncertain timing or amount. Okay, the clear version on the right cuts right to it. We are involved in a few ongoing legal disputes. We list the maximum possible cost here if we lose. Boom. Instantly you get it. You understand the risk. This proves such a crucial point. You can be legally accurate and be perfectly clear. Those two things are not enemies. In fact, you could argue that real accuracy actually requires clarity. All right, next up, lease liabilities, or as we like to call it, the rent debt. This basically covers all of a company's long-term rental agreements for the stuff it needs to operate. Office buildings, warehouses, cars, equipment, the whole shebang. The original text is just loaded with financial math terms like present value of future lease payments and incremental borrowing rate. Our translated version cuts through all that noise. It's simply about figuring out the total rent a company owes for years, and then, and this is the key part, adjusting that huge future number to what it's worth in today's money. See? A simple, powerful analogy like today's money can do more work than a dozen technical terms. It just bridges the gap, right? It makes a complex financial calculation something everyone can grasp, not just the accountants. For our final example, we're tackling what is often the most confusing section of all, employee benefits. This is where you run smack into what we call the actuarial wall, this highly complex world of pension promises and, frankly, a whole lot of expert guesswork about the future. So the jargon here it's intense. Actuarial gains and losses are recognized through other comprehensive income OCI. What in the world does that even mean? Well, the clear version spells it out. Experts are always guessing what future pension costs will be. If their guess changes, the company records that financial swing in a totally separate bucket so it doesn't mess up their regular profit reports. Notice we didn't just translate the what there, we explained the why. The jargon completely hides this critical insight. This whole accounting move is specifically designed to stop those wild pension estimates from making the company's core profits look unstable. So, after auditing these different kinds of risks, what did we actually learn? Well, it turns out you can pull out 3 pretty simple rules for clear communication from these examples. We call them the 3 pillars of clarity. First, use direct analogies, like maybe debt, to make these abstract ideas feel real. Second, always explain the purpose, the why behind something, not just the what they're doing. And third, and this is a big one, write for an intelligent reader, not a tiny group of niche experts. Now, this is about so much more than just good writing. In the real world, these principles of clarity, they become a kind of secret weapon. They can create a really powerful competitive advantage for any company that actually decides to embrace them.
But that brings up a pretty obvious question, doesn't it? If being clear is so powerful, why are so many of the world's most important documents still so incredibly hard to understand?
Well, it's almost never a grand conspiracy. Jargon usually sticks around for a few powerful reasons. You've got lawyers who are, playing it safe by using old, court-tested language. You've got accountants who need extreme technical precision. And maybe the biggest reason of all is just institutional inertia, the simple idea that, hey, this is just how we've always done it. But that tide is starting to turn against those old habits. Because in the world we live in today, the rewards for choosing clarity are becoming way too big for any organization to just ignore.
I mean, think about it. Clarity builds trust, right? And that trust leads directly to higher investor confidence. And when your investors truly get your business and its risks, it can actually lower the cost for you to borrow money. All of that works together to build a rock-solid reputation that is really hard to beat.
And this really gets to the very heart of why this stuff matters so much. An informed public, whether we're talking about investors or employees or just citizens, is the absolute bedrock of a strong economy and, frankly, a healthy society. Clarity isn't just a nice to have, it's essential. So the next time you're faced with a wall of dense text, just remember that you have the tools to audit it for yourself, to break it down, and to find the real meaning hidden inside. The only question is, what are you going to uncover?